The most valuable companies on Earth are racing to sell you their stock. For decades, the best tech companies stayed private, growing in the dark. But now, the vault doors are finally swinging open, giving everyday investors a chance to buy into the artificial intelligence boom. But in the stock market, an open door is never a favor. Every trade needs a counterparty. If you are trying to buy a share of stock, someone on the exact opposite side of that trade has to be willing to sell it to you. So before you buy, you have to ask, who is actually selling? In an initial public offering, those sellers aren't random. They are the venture capitalists who funded the startups, the early employees, and the founders who built these companies from the ground up. Nobody understands these businesses better than they do. They have seen the raw numbers and the internal financial projections that you and I will never get to look at. If AI is truly the most valuable technology of our lifetime, why are the most informed people on Earth in such a hurry to take your cash instead of holding on to their own stock? In poker, a player's physical habits often signal the strength of their hand, regardless of what they say. Financial markets operate with similar transparency. While average investors buy based on public optimism, professional money managers often do the opposite, selling when the line of buyers is out the door. This pattern appeared clearly right before the 2008 crash. In June of 2007, the founders of Blackstone took their asset management firm public, walking away with roughly $2.6 billion in cash. A little over a year later, the global financial crisis hit, and Blackstone's stock dropped 90%. The same sequence occurred in 1999. In the year leading up to the dot-com crash, tech companies rushed to the public markets at a record pace. Insiders liquidated their positions, handing their shares to retail investors who believed they were securing a piece of the digital future. Then, the bubble popped. Over the next 2.5 years, the Nasdaq crashed more than 75%, and $5 trillion in market value evaporated. Most of those newly public companies never made it to the other side. This behavior surfaced again in 2021 through SPACs, blank check shell companies that allowed startups to bypass the scrutiny of a normal IPO. Insiders raised billions from the public, and within a year, the companies that merged via SPACs lost an average of 67% of their value. This is the dine and dash. When markets are euphoric, insiders use public hype as cover to offload highly risky assets onto uninformed buyers. To understand why this is happening again, we have to look at the exact data AI insiders are seeing right now. This chart shows the capital expenditure of the largest tech companies on Earth. This year, they are on track to spend $725 billion building out AI infrastructure. That breaks down to roughly $23,000 every single second. On the other side of the ledger, the return is starkly different. Over the past 12 months, the entire global AI economy generated an estimated $110 billion in revenue. The industry earned back just 15% of what big tech alone plans to spend this year. For the businesses actually deploying this technology, the economics are even more difficult. A recent MIT study found that 95% of corporate AI rollouts produced zero measurable financial return. OpenAI is the clearest example of this financial gap, particularly in light of their confidentially leaked financials. Last year, OpenAI brought in around $1.3 billion in revenue. However, the costs to maintain these models are so high that by 2025, they project a net loss of $38.5 billion. Despite these losses, their latest funding round valued the company at $852 billion, more than 65 times their current revenue. This gap between AI's operating costs and its actual earnings is why insiders are racing to cash out. They're selling into the hype before the market requires the fundamentals to match the price tag. Insiders continue to promote AI because they are locked in a technological arms race. Maintaining their position requires billions of dollars a month, which means they need access to the deepest pools of capital available. Their strategy mirrors a famous quote from the summer of 2007. Months before the financial system began to break, Citigroup CEO Charles Prince was asked why his bank continued to finance risky debt. He replied, "As long as the music is playing, you've got to get up and dance." This admission frames high finance as a multi-billion-dollar game of hot potato. The players understand the risk of the underlying asset, yet the objective remains the same: offload it to a new buyer before the music stops. The final destination for this risk is the United States stock market. Founders and insiders holding AI stock are passing those shares to an enthusiastic crowd of retail buyers. Predicting the exact day the music stops is impossible. These companies could trend higher for years before the market corrects. You don't need a specific date to recognize a cycle. By watching what the insiders do with their own money, you read the room, and make sure you aren't the last one left on the dance floor.